All right, well, it is a few minutes after 4, so we're going to go ahead and get started. And like I mentioned, it's great to see both new and returning faces. And I don't know about those of you in Aspen, but I'm sure the people in Denver are loving some sunshine and a break from the last week. Yeah, it's great to see everyone. And so my name is Brian Brady, and I'm the Director of Marketing and Communications at Obermeyer Wood. And welcome to our February virtual event. I would like to remind everyone that we have a lot of people on this call, so we ask that you remain with your microphone on mute for the duration of the presentation. If you have questions, and we're expecting that there are going to be a lot of questions, and we encourage that, we would ask that you put those questions in the chat box, which can be found at the bottom of your screen. We are going to leave about 25 minutes for Q&A at the end, so please ask those questions when they come up. I'd also like to point out that Mary Beth is going to be presenting a slideshow. Sometimes when people present slideshows on Zoom, some of the content can be blocked by little photos of people on the side. If you hover your mouse over those photos on the top left-hand side, you'll be able to minimize those screens so that you should be able to see everything. But again, if you have any questions, put them in the chat and we're happy to help out. I'd also like to take this opportunity to tell you guys that next month's event, the March event, will be on March 25th. Our guest will be Jeff Kleintop. He is the Chief Global Investment Strategist at Charles Schwab, and we are very excited to host him, and we should be sending out an invite for that in the coming 2 weeks. And so before we get to our speaker today, I've asked my colleague, Allie Phillips, Executive Vice President and Partner, to say a few words. Allie, the floor is yours.
Hey, thanks, Brian. So good afternoon. For those of you who don't know me, I'm Allie Phillips, Executive Vice President Partner at Obermeyer Wood, and I've been with the firm for about 16 years. Our team is so excited to host you for our February virtual event, the latest in our series of monthly webinars designed to inform and educate our clients and friends on a wide range of topics, including finance, markets, arts, culture, current events, and today's Social Security. We get so much joy at being able to see you on Zoom every month for these events. It's really been one of the silver linings for our firm during this socially distanced year. And on behalf of everyone, I can't tell you, we can't wait to see you in person and are very hopeful we'll be able to do that in the coming months. We hope everyone's having a great start to 2021. And it's a good time to remind you that we are always available and eager to meet with you if you want to talk about your year-end statement, any changes in your financial life, or really just want to tell us what's on the top of your mind. And on that, as we all know, being top of mind is upcoming is tax season. One of our core services that we offer is coordinating directly with your other trusted advisors, so we can make sure your financial house is in order. So please let our team know if you'd like us to send information to your tax professional or answer any questions or issues that come up. Now with that, I'm delighted to have the chance to introduce our guest speaker, Mary Beth Franklin. Mary Beth Franklin is the president of Retire Pro and a contributing editor to Investment News. She's a nationally known and frequently quoted expert on Social Security claiming strategies, having maintained a long-time interest and expertise in retirement issues, Social Security, and taxes, with a background in the federal budget, international trade, and Capitol Hill as it affects personal finance. She has been a financial journalist for more than 40 years, covering everything from budget, tax policies as the Capitol Hill reporter, and for the United Press International to consumer finance, and a writer and editor at Kiplinger's Personal Finance magazine. In her free time, Mary Beth likes to read, garden, ski, which we all love, and play the piano. She received her BA in communications from American University, where she continues to mentor journalism students. And for me personally, I have been following Mary Beth for years, and I've often sent her articles and podcasts to clients to be able to address the various questions. So Mary Beth, I can't thank you enough for being with us here today. Very excited to have you join us and look forward to learning a lot from you in the next hour. So with that, let me turn it over to you.
Thank you so much, Allie, Brian, and Wally for introducing me to your Obermeyer Wood family. And I hope you find this interesting. Believe it or not, there are about 2,700 rules that govern your Social Security benefits, only in the federal government, right? Don't worry, I won't go through all of them, just the highlights, and I'll try to keep it entertaining as well. The most important thing you need to know about Bear with me. We're having technical difficulties already. The most important thing you need to know about me is that my face is literally on a dartboard at the Social Security Administration. I have that on good authority, and it's truly my proudest moment. I have spent the last 10 years or so trying to educate consumers and financial advisors about the best way to claim their Social Security benefits to maximize those benefits over their lifetime. And it all depends on your health, your marital status, and your other sources of retirement income about what is the best claiming strategy for you. But as we know, the COVID-19 pandemic has upended all of our lives and also changed some people's decision of when they plan to retire or when they plan to collect Social Security benefits. Some people are saying, gee, I lost my job due to the pandemic. I may need to collect sooner than I thought. Others are watching the market go crazy and saying, is this the time I really want to tap my investments? Maybe I should take Social Security now and let my investments rise. Other people are saying, I keep hearing Social Security is just going to go broke. Let me grab it while I can. Well, I'm going to go through some of these scenarios during my presentation, and feel free to send me your questions, and Brian's going to read them to me at the end, and we will get to as many of them as we can. Now, generally, the idea is the longer you wait to collect your Social Security benefits up until age 70, the bigger your benefit's going to be. Well, that's certainly a pro, because the longer you wait and the bigger your base benefit, each year when there's an annual cost of living adjustment, it's being applied to a larger base. So you get a bigger COLA adjustment. And for married couples, particularly, the idea of waiting to collect the biggest benefit possible for at least one spouse generally means that you are creating a larger possible survivor benefit for the surviving spouse. But it's not a slam dunk. There are downsides to deciding to wait to collect Social Security benefits until you're older. The first is obviously reduced cash flow now if you're delaying that benefit. And then there's that higher break-even age. In other words, how long do I have to live to make the decision to delay benefits worthwhile? Well, frankly, I think the idea of break-even age is overstated. Frankly, if you die before you collect benefits, it doesn't matter. You're dead. But it will matter to your survivor if you're married. But the idea of delaying, say, till 66 rather than 62, how long do you have to live to make that decision worthwhile? About 78 years old, which is well below average life expectancy. Delaying till 70, frankly, you have to live till about 83 to make it a worthwhile decision. But again, less than average life expectancy, which is about 84 for a 65-year-old man and 86 for a 65-year-old woman. And that's truly the median. Half of all Americans will live longer than that. Now, if you do decide you want to claim early, that's fine. That's your decision. But know that the age at when you first claim benefits affects the amount of those benefits for the rest of your life. And understand that if you claim benefits before your full retirement age and continue to work, in other words, have earnings from a job or net self-employment income, it could reduce or even wipe out those benefits temporarily if you earn too much money. And finally, learn that there are ways you may be able to reverse those decisions later. So let's talk about eligibility. In order to be eligible to claim Social Security, you need a minimum of 40 credits. That's essentially at least 10 years of covered earnings. But the amount that you actually receive is based on your age at time of claim and your top 35 years of index earnings. If you work 40 years, those lowest 5 years are going to drop out and your benefits will be based on your top 35 years of average earnings. If, say, you work 20 years, they're still going to use 35 years to determine your benefits. It means you'll have 15 years of zero earnings, and that's going to mean lower average lifetime earnings and lower benefits as a result. So your age at the time of claim is a key factor. Yes, you can collect your Social Security benefits as early as age 62, and that may be appropriate in some circumstances, but it means your benefits will be reduced by 25% or more for the rest of your life, depending on the year you were born. Now, if you wait until your full retirement age, you can collect full benefits that you have paid so much for in the form of FICA taxes and worked so hard for. And you can keep all your benefits even if you continue to work, because those earnings restrictions go away once you reach your full retirement age. But if you are willing to be patient, there is a huge payoff. For every year you are willing to delay collecting your benefits beyond your full retirement age up until age 70, you earn an extra 8% per year. That is huge in what is essentially a zero interest rate environment. And if you say, well, I'll grab it now and I'll invest it, I don't need the money. Well, that's great. Invest it in the stock market. You make 20%, you might lose 20%. You really have to compare it to a risk-free investment, which is essentially your bank account. You're making less than 1% there, and the government's saying, I'll give you 8% a year. That is essentially a smoking hot deal for people who are healthy enough, because you have to be around to collect this bigger benefit later, and wealthy enough, in other words, have other sources of income while you wait to collect that bigger Social Security benefit later. Now, these delayed retirement credits that are worth 8% per year, technically 0.66% per month, which adds up to 8% a year, for every year you postpone between your full retirement age and age 70. But who gets these delayed retirement credits? They're called delayed retirement credits for a reason. They only apply to a worker's retirement benefit. If you are collecting benefits as a spouse because you didn't have enough benefits on your own record, but you're married to someone who it is, your highest benefit is if you collected at your full retirement age. It does not continue to grow up until age 70. Same thing with survivor benefits. If you are a widow or a widower and you're collecting survivor benefits, your biggest survivor benefit is if you collected at your full retirement age. It does not continue to grow. However, if one spouse has delayed until age 70 to get the biggest benefit possible and then dies, the survivor benefit is worth 100% of what that deceased worker was collecting at time of death, including any delayed retirement credits. And that's why married couples particularly should consider that at least one spouse may want to wait till age 70 to collect benefits. Now, here's a stark example of the difference of claiming benefits early or late. Let's assume your full retirement age benefit at age 66 is $2,000 a month, but you decide to collect early at 62, 4 years early. You're not going to get $2,000 a month. You'll get 75% of that, or $1,500 a month. Instead, you might want to wait until 70. You'll get an extra 32%, $2,640 a month at age 70. The difference between claiming as soon as possible at age 62 and as late as possible at age 70 means a 76% increase in your monthly Social Security benefits for the rest of your life. As a certified financial planner, there is no investment I can recommend to you that is guaranteed to increase by 76% over an 8-year period. Now, for the younger members of the audience, you have a backdoor benefit cut. The full retirement age is increasing. And in fact, this year, 2021, is the first year that the full retirement age has increased in quite a while. It is now 66 and 2 months for people who reach that age this year in 2021. And my full retirement age is 66. I was born in 1954. If I had claimed benefits early at 62, I'd get a 25% haircut. If someone who's born in 1960 or later, whose full retirement age is 67, they can still claim early at 62, but for them, it's 5 years early. And they're going to get a 30% haircut if they claim that early. And they can also wait till 70 to collect the largest benefit possible, but they won't get a 32% increase like I would. There's only 3 years between their full retirement age of 67 and the maximum age of 70. So their biggest increase is 24%. And a lot of times people will say to me, well, my full retirement age is 67. Should I wait till 70 to claim my benefits? And I always give them the same answer. Frankly, I have no idea. It all depends on what interest rates are at the time. But right now, in this zero interest rate environment, it's an incredible deal to get 8% per year in delayed retirement credits. And for those who are willing to wait, it's a big payoff. Now, as I mentioned, 2021 is a watershed year because it's the first time that the Social Security full retirement age has increased. People who were born in 1955 who turned 66 this year must wait till 66 and 2 months to reach their full retirement age. 2021 is also important because most of the creative claiming strategies that were available to previous waves of retirees have essentially disappeared. There's a small group of retirees who were born on or before January 1st, 1954, meaning they were at least 66 years old by 2019, that still have some creative claiming options. Now let's talk about this earnings cap for a minute. If you claim benefits before your full retirement age and continue to work, that means earnings from a job or self-employment, and you earn too much money, you're going to lose some or all of your benefits. And believe it or not, too much money in 2021 is $18,960 a year. If you earn more than that, you're going to lose $1 in benefits for every $2 over that limit. Now, there's a higher earnings limit in the year you reach your full retirement age, in the months before you reach that milestone. This year, it's about $50,000. And once you reach your full retirement age, the earnings restrictions disappear. So my number one rule is if you plan to keep working, in most cases, it makes no sense to claim Social Security before your full retirement age. And keep in mind that all type of Social Security benefits, whether it's a retirement benefit on your own earnings record, a benefit as a spouse on your mate's earnings record, or a survivor benefit, they are all subject to the same earnings limit. But keep in mind that any benefits that are lost to excess earnings are not gone forever. Once you get to your full retirement age, any benefits you lost due to the earnings cap are restored in the form of larger monthly benefits. Now, let me give you an example of how this works. Let's say we have a 64-year-old who earned about $30,000 this year in 2021 and decides to retire. Maybe he or she had health issues and due to COVID, didn't want to go back to work. Now that's significantly more than the annual earnings limit of $18,960. So we would subtract that earnings limit from the worker's annual earnings, and we come up with excess earnings of over $11,000, and we're going to lose half of that amount to benefits. That means if this person was eligible for $2,000 a month of Social Security benefits, Social Security is going to withhold 3 months benefits to satisfy that earnings cap, and then we'll start paying benefits for the rest of the year. And this earnings limit repeats year after year until you reach your full retirement age. But there is this escape hatch that's working particularly well for people affected by COVID who are choosing either not to go back to work for health reasons or who have lost their job. It basically says that even if you have exceeded the annual earnings limit, once you claim Social Security benefits, as long as your monthly earnings don't exceed the limit, you can still get Social Security benefits. So in this case, just like the example before, we have a 64-year-old who earned $30,000 in 2021 before retiring and applying for benefits in June. As long as his monthly earnings from a job don't exceed $1,580 a month, that's 1/12 of the annual's limit, then he can get full Social Security benefits for the rest of the year. And then the next year, the annual limit applies. Now, keep in mind, if you're not working, you don't have to worry about the earnings limit. It only applies to income from jobs. Now, let's talk about claiming strategies to maximize benefits. For married couples, the goal for most of them should be, how do I maximize the survivor benefit? And I do that by having at least one spouse wait until age 70 to claim. And as I explained earlier, that's because by creating the largest possible retirement benefit while both spouses are alive, you are likely to create the largest possible survivor benefit. Because when one spouse dies, the larger benefit will continue and the smaller benefit will go away. And a survivor benefit is worth 100% of what the deceased worker was claiming or would have been entitled to if they died before claiming. Now, how do we coordinate these claiming strategies? If we have the higher earning spouse wait until 70 to claim benefits, what does the other spouse do? Let's think of this as a household decision rather than two individual decisions. It may make sense for the other spouse with the lower benefit to go ahead and claim reduced benefits at 62. Now that's assuming she's not working, or at full retirement age if she is. Why do that? It brings some money into the household, taking away a bit of the sting of the other one to wait. And here's the thing that most people don't realize. Even though by claiming reduced retirement benefits early, and those retirement benefits are reduced for the rest of her life, it will have no impact on her survivor benefits. If she is at least full retirement age, when she starts collecting survivor benefits, she still gets 100% of what her late husband was entitled to collect at time of death. Now, there's a little wrinkle in this. For traditional couples where perhaps a spouse who has stayed home raising kids has no Social Security benefit on her own record, she cannot collect a Social Security spousal benefit until her husband collects his benefit. Different rules apply to divorced spouses, and I'll talk about those in a minute. Now, this disappearing claiming strategy I mentioned earlier, individuals who were born on or before January 1st, 1954 have this special claiming option. If you're in that situation and you wait till your full retirement age or later to claim Social Security, and you're married, or what's considered an eligible divorced spouse, you can say to Social Security, don't pay me my retirement benefits. Let my Social Security benefits continue to grow by 8% a year up until age 70. But in the meantime, pay me as a spouse. Give me half of my husband's benefits. Give me half of my wife's benefits. Now, the tricky part is that other spouse actually has to claim a benefit in order to trigger a spousal benefit. And I can speak from personal experience. I turned 66 last December. I missed that birthday cutoff because I was born in December 1954. I can't do anything fancy. But my husband is 2 years older than I am. He was born in 1952. He had the ability to claim spousal benefits only, but the catch was I had to claim my benefit first, which I did in December, to trigger a spousal benefit for him. He now gets half of my Social Security benefits, and once he turns 70, he can then switch to his own maximum benefit. That's also going to create a larger potential survivor benefit for me should Mike die first. Unfortunately, people who were born after the January 1st, 1954 cutoff can't do anything fancy anymore. That doesn't mean deciding when to claim Social Security isn't still an important decision for them. It's a critical part of the overall retirement income picture. Now, how much is a spousal benefit worth? If I claim it at my full retirement age, and let's say my full retirement age is 66, I can get 50% of my husband's full retirement age benefit. If my full retirement age is 67, well, then I have to wait till 67 to claim to get half of his benefit. I can claim earlier, but those benefits are permanently reduced if I claim before my full retirement age. Now let's talk about rules for divorced spouses, because boy, is it complicated. Now, if you were married at least 10 years, are divorced, and are currently single, you may be able to collect benefits on your ex-spouse's record. Now, just like any other kind of Social Security benefits, If you're entitled to your own retirement benefit and a benefit as a spouse, generally Social Security is going to pay you the higher of the two amounts, but not both. Now, I mentioned earlier for currently married couples, one spouse actually has to claim his or her Social Security benefit in order to trigger a spousal benefit for the other spouse. Now, you could imagine that might be ugly if you had a nasty divorce and one spouse said to the other, and I am never going to retire and you are never going to get a dime of my Social Security benefits. Well, Congress thought that might be a problem. So among the 2,700 rules that govern Social Security benefit, about half of them are exceptions. And a lot of those exceptions apply to divorced spouses. So Congress said, in addition to being married at least 10 years before divorcing and currently single, if both ex-spouses are at least 62 years old and you've been divorced at least 2 years, you may be able to collect on your ex's record even if your ex has not yet claimed. That's known as being an independently entitled spouse. Now, again, the basic rules apply. Your benefit as an ex-spouse is going to depend on your age at the time you claim it. And if your own benefit is larger than half of your ex benefits, you're going to get your own full retirement age benefit. If your benefit is smaller, once you claim, Social Security will pay you your own benefit and then top off any excess spousal amount to bring your total up to half of your ex's benefit amount if you're full retirement age. If you're younger, it's going to be worth less. Let me give you an example. Let's say we have an eligible divorced spouse. She's born in 1953, so she can still do something fancy. That means she turned 68 this year in 2021. She's not yet claimed Social Security, and neither has her spouse. He's also 68 years old. His benefit is worth $2,400 a month. Hers is worth $2,000. Because she was born before 1954, and she was married at least 10 years and currently single, she can file a restricted claim for spousal benefits. That means don't pay me my benefits, let them keep growing by 8% a year up until age 70, but in the meantime, pay me half of my ex's benefit. Talk about the ultimate revenge. And the thing is, he doesn't even need to know about it. You just go through the Social Security Administration, you prove that you are who you say you are with your marriage license and your divorce decree, and they will take care of the rest. And at 70, this ex-wife would then switch to her own maximum benefit, which would be worth her full retirement age amount plus 32%. Now, another thing to note about divorce benefits, even if she claims on her ex's record, it doesn't affect his benefits at all. It does not reduce his benefit. Even if he has remarried, it is not going to reduce the benefit of his new wife. She is an independently entitled spouse and can collect this benefit on her own. Now, to collect benefits as an ex-spouse on a living ex, you have to be single. Even if you remarried in between, as long as that subsequent marriage ends through death or divorce or annulment, you're now single, you can collect on your ex. I mentioned all these Social Security rules. Here's a really crazy one. Even if you remarry, as long as you waited till age 60 or later to remarry and your ex-spouse dies, you can collect survivor benefits on your ex, even if you're married to someone else. And here's a quick review. Remember, spousal benefits while your ex is alive is worth 50% of his full retirement age benefit. Survivor benefits when your ex is dead is worth 100% of his benefits. So yes, your ex is worth twice as much dead than alive, but I bet you already knew that. Now, let me say this. I've been married 43 years. This rule does not apply to me, but I have two dear girlfriends who were each married 9.5 years, and apparently their divorce attorneys did not know that they had to be married at least 10 years to be able to collect on their ex-husbands. Consequently, they will get squat when it comes to Social Security benefits. So if you remember nothing else from my presentation, please take away this little nugget and tell your family and friends. that there must be at least a decade between I do and I don't. And if that marriage is falling apart, stretch out the paperwork, because the only dates that marry are the date that you're married and the date of your final divorce decree. And I know a lot of you may have concerns about the financing of Social Security. Well, the future of Social Security has less to do with the trust funds and a whole lot to do with divorce. Let me give you an example of these crazy rules. Let's say we have John and Mary, and they're married for 10 years, and then they get divorced, and Mary remains single. Well, John decides to marry his secretary, Susie. You know this story. John and Susie remain married for 10 years, and then they get divorced, and Susie remains single. Well, John's one of these guys that doesn't like to be alone, and he meets a lovely young woman named Tiffany, and they fall madly in love and get married. Tiffany's 30, by the way. And then they have a little baby, Johnny. Johnny's now 2 years old, and John, the dad, drops dead. Who gets survivor benefits? Well, Mary, the first ex-wife, married at least 10 years, divorced, and currently single, gets 100% of John's survivor benefits. She does not have to share. And so does his second ex-wife, Susie, married at least 10 years, divorced, currently single. She gets 100% of John's survivor benefits. That's 200%. Then there's his widow, Tiffany, 32 years old, caring for his son, little Johnny. She gets 75% of John's benefits every year till little Johnny turns 16, and little Johnny gets survivor benefits until he turns 18. So when you worry about the long-term financing Social Security, worry less about the trust funds and more about the divorce rules. Now, here's an important rule for survivors. Whether you're a widow or a widower, when your current spouse dies, or a surviving ex-spouse when your ex dies, and you have your own retirement benefit, you may be able to collect one type of benefit first and switch to the other later if it's larger, and it doesn't matter in which order. Let me give you an example of how this works. Let's say I have a small retirement benefit on my own work record, and my benefit as a survivor is going to be bigger, and I'm a young widow. I may want to collect my own reduced retirement benefit first at 62, assuming I'm not earning too much because of the earnings cap. And even though my own retirement benefits will be permanently reduced because I collected them early, I can still switch to my full survivor benefits at my full retirement age, and that's what I'll get the rest of my life. If, however, my own retirement benefits are likely to be larger, I could collect my survivor benefits at my full retirement age, even if I'm still working, because that's when the earnings restrictions go away. And survivor benefits are worth the maximum amount at my full retirement age. They don't get any bigger. But my own retirement benefits continue to grow by 8% a year up until age 70. So at that point, I could collect survivor benefits first and switch to my own larger retirement benefits later. So how much are survivor benefits worth and when can I get them? They're a little different than retirement benefits. You can collect them as early as age 60, but they are reduced if you claim them early. And as I mentioned, there are exceptions. If I'm caring for the surviving child of a deceased worker, I can collect benefits regardless of my age until that child becomes 16. Now, what about single people? What should they do? And I'm talking single people who were never married or who were divorced before they had been married 10 years. Their benefits are simply based on their age at time of claim. They can get reduced benefits early, they can get full benefits at their full retirement age, or bigger benefits at 70. Now, delaying until 70 may make sense in some circumstances. Certainly their benefits would be bigger, but there's a potential downside there. If I'm single and I die before collecting any benefits, nobody gets a survivor benefit. I have no surviving spouse or children, so the money just goes back into the Social Security pot for future beneficiaries. So I say for most single people, you probably want to wait until your full retirement age, particularly if you're still working, to claim benefits. You may not want to wait until 70. If you don't need the money, you can just claim the benefits and bank them. Now, what about if you change your mind? There are two important do-over strategies. The first is anybody has the right to change their mind within the first 12 months of claiming benefits. They can do that by withdrawing their application, but there's a catch. You have to pay back any benefits you have received. And if anybody's collecting on your record, like a spouse or a child, you have to pay those benefits back too. Well, why would I want to do that? It's because it wipes the slate clean as if I've never collected Social Security. So at a later date, when I'm older, I can collect a bigger benefit as if for the first time. Who would want to do that? Well, I'll give you an example in a minute. The other strategy is if I miss that 12-month window, I can now wait until I reach my full retirement age and suspend my benefits. It means I don't have to pay anything back. But during that suspension, nobody can collect benefits on my records except a divorced spouse. They always get the exception. And I can't collect on anybody else's record. Who might want to do that? Well, let's say we have a husband who collected benefits at 62 just because he could, and he was fine with reduced benefits, but it didn't occur to him at the time that if he collected a smaller retirement benefit and he died first, he is condemning his widow to a smaller survivor benefit. He may want to suspend his benefits when he gets to his full retirement age. Now, it means his checks are going to stop, but now they're going to grow by 8% a year between his full retirement age and 70. It would effectively restore his full retirement age benefit by age 70. And if he dies first, that's the benefit his widow would get. Excuse me. Here's an example. Let's say this man's benefit, his full retirement age is 66, but he went ahead and claimed early at 62. Instead of getting $2,000 a month, he only gets $1,500 a month. That's 75% of his full retirement age benefit. At 66, he suspends his benefits, so his checks stop for up to 4 years. But now he's earning 8% a year in delayed retirement credits, a 32% increase. If I multiply that 75% of the benefit he was getting by 1.32, it comes out to 99%. That's effectively restoring his full retirement age benefit when he resumes it at age 70. And that would be the amount of survivor benefits his widow would get if he died first. Now, here's a mention for public employees, and this is a big deal for some people in Colorado, and I know a lot of you are in Colorado. If you receive a pension from work in the public sector, including Colorado school teachers, where you did not pay FICA taxes, the rules are different for you. There are two separate rules. Let's say you worked in the private sector long enough, at least 10 years, to earn a Social Security benefit, but you also had this public pension from Colorado that was based on work where you did not pay FICA taxes. You will get your own Social Security benefit, but it will be reduced by something called the Windfall Elimination Provision, WEP. Think W, windfall worker. It says you will get a Social Security benefit, but it can be reduced by up to half of the amount of your public pension. There's a limit to that reduction. It's about $500 a month. If you get a $2,000 a month pension, they can't reduce your Social Security benefit by more than $498 a month this year. There's a separate rule that applies to spousal benefits and survivor benefits. It's called the Government Pension Offset Rule, GPO. Often think of it as Grumpy Partner Rule. It says, let's say you're a Colorado school teacher and you've never earned your Social Security benefit, but you figure, of course, you can collect a benefit on your husband's record. Not so fast. Social Security will apply the Government Pension Offset Rule, which says we will reduce any potential Social Security spousal or survivor benefit by 2/3 of the amount of your public pension. So let's say your pension is $3,000 a month. 2/3 of that is $2,000 a month. Social Security will subtract $2,000 a month from any potential spousal benefit while you're husband is alive, that's going to wipe that out, or any potential survivor benefit if he dies first. That's going to significantly reduce, if not eliminate, the survivor benefit. So I usually tell married couples where one spouse is a public sector employee affected by these rules, that maybe the spouse who's collecting Social Security does not want to wait till 70 to claim, because the main reason you want to delay benefits till 70 is to create the largest survivor benefit possible. But if your surviving spouse can't get that survivor benefit, why wait? As I mentioned, it's only states where public employees don't participate in the Social Security system. There's 12 states and Colorado is one of them. Also, federal workers who worked under the old civil service retirement system did not participate in Social Security and are subject to reductions. There's a separate federal employee system now where they do participate. And there are two exceptions. If someone is subject to the windfall elimination provisions, but they've worked at least 30 years under Social Security, those reduction goes away. And if they paid FICA taxes during at least the last 5 years of the government service, they're also not subject to the government pension offset rules. Now, let me talk briefly about Medicare because it fits hand in hand with Social Security. Medicare has 4 parts. Part A, hospital insurance, is premium free for most people because you've paid for it through your FICA taxes throughout your career. Medicare Part B is the health insurance portion that covers doctor's fees and outpatient services. That carries a monthly premium and is usually deducted directly from your Social Security benefits. If you're not yet receiving Social Security, then you're billed quarterly for this. There's Medicare Part D, drug coverage. And then for people who like to get their Medicare all combined into one HMO-like package that includes Medicare A and B and drug coverage and usually extras like vision and hearing aid, maybe gym membership, that's called Medicare C or Medicare Advantage. Now, Medicare premiums for Parts B and D are tied to your income. The higher your income, the higher your monthly Medicare premiums. Now, there are 6 income brackets, and these are known as income-related monthly adjustment amounts, or IRMA. And if your income exceeds the bracket by even $1 and throws you into the next higher bracket, it's going to cost you a lot of money. Now, Medicare premium surcharges are based on your last available tax return. That means this year's premiums in 2021 are based on the tax returns for 2019 that you filed last year. And if your modified adjusted gross income in 2019, which was your last available tax return, was $88,000 or less if you're single, or $176,000 or less if you're married, no worries. You are paying the base income this year, which is $148.50 a month. But you go $1 over $88,001 or $176,001, and you're into the next bracket, paying an extra $60 a month. As you can see, these brackets get more and more costly, and people in the top income bracket are paying over $500 a month per person for Medicare Part B, plus they're paying extra for Medicare Part D prescription drug coverage, and they probably have a Medigap policy as well. And if both spouses are over the age of 65, multiply by 2. This is probably one of the biggest expenses that most retirees will face in retirement, but there may be something you can do about it. If you are subject to these high income surcharges, you will receive a letter from Social Security each fall that basically said, hey, good news, you made too much money, you're going to pay more for Medicare next year. Right in that letter, it explains how to appeal those surcharges if your income has decreased since your last available tax return due to a life-changing event, that is listed in that letter. Things like you got married, you got divorced, you became widowed, you retired, your spouse retired or reduced hours, your pension plan was terminated. Those are all life-changing reasons where you can appeal your Medicare premium surcharge. But some income can't be appealed. My income went up because I had a big capital gains from the sale of investment portfolio or second home, or I sold my business, or I took a big IRA distribution, or I converted some of my traditional IRA to a Roth IRA. All those things are going to boost my income for at least a year. And if my income goes up, the Medicare premiums will go up 2 years later. But the good news is Medicare premiums are reset each year. And if the following year your income goes down, then likely your Medicare premiums will go down as well. But just like the regular tax return, some income doesn't count in this Medicare premium calculation. Distributions from Roth IRAs or Roth 401ks do not count. Distributions from health savings accounts used to pay medical expenses do not count. Loans or distributions from cash value life insurance, proceeds from a reverse mortgage, or, and this is probably the best tax planning strategy going forward, is if you are subject, well, let's say that again. If you are 70 and a half or older, you can direct distributions from your IRA directly to a charity. And if you do, that distribution, that charitable distribution does not show up on your tax return and consequently does not increase your Medicare premiums. Now, there are planning opportunities. Last year, due to the pandemic and the resulting recession, people did not have to take required minimum distributions. This year, they're back for 2021. So make sure you take your RMD. If not, there's a big penalty. The tax penalty is 50% of the amount you failed to withdraw. Nobody wants to get hit with that. This year, therefore, you can direct up to $100,000 directly from your IRA to a charity. The key is direct those qualified distributions to the charities before you take your RMD. If you take your required minimum distribution first, you can't say, oh, by the way, apply that to the charity. The money has to go directly from the IRA to the charity. Now, there was some legislative changes. The Secure Acts changed the required minimum distribution age from 70 and a half to 72, but the ability to direct money from an IRA to a qualified charity remains at 70 and a half. So that's the end of my presentation. Some people have complained it's a bit like trying to drink from a fire hose. I hope I didn't overwhelm you too much, but now I'm ready to take as many questions as you can fire at me. And Brian is going to read those questions to me.
Yes, and I would remind folks, if you have questions, put them in the chat, make sure you send them to me. You can find my name from the drop-down menu within that chat. We have a few. The first one kind of has to do with process, and that is, if someone wants to wait to collect at 70, when do they need to contact Social Security? Do they do it at full retirement age or at 70 when they're ready to take the payments?
Great question. Well, first of all, in this new socially distanced world, you may have noticed that you can't go into a Social Security office. All the field offices are closed nationwide. So the only way you can apply for benefits is online at ssa.gov, socialsecurity.gov. It's really a pretty easy process, and you can apply for benefits up to 4 months before you want them to begin. And it's very straightforward, but here's a little trick about applying at 70. You can apply for your benefits to begin in the month you turn 70, and you will get the full amount, your full retirement age benefits, plus up to 32% more, assuming your full retirement age is 66. If, say, you decide to claim benefits at 69 and you've earned 3 years worth of delayed retirement credits, you won't get them all at once. You will get all the benefits, the delayed retirement credits you earned through the previous December when you first applied, and then the next year you'll catch up with the rest. If you actually wait until your 70th birthday month, you will get all the delayed retirement credits at once.
Great. So the next question has to do with Colorado specific rules, which I know you went pretty deep into, but could you go back over, I think you kind of mentioned at the end, could you go back over the Colorado specific rules as it relates to one of the spouses not delaying?
Right. Okay. First of all, the key is the triggering event is if you have a pension from a public system where you did not pay FICA taxes. If you're a public employee and for some reason you don't have a pension, these rules don't apply. And these offsets only apply once you claim that pension. So some people could be, say, a Colorado public teacher and maybe claim Social Security for 2 years if they had their own benefits, reduced benefits early. And then once the Colorado pension kicks in, then the offsets will apply. But let's assume we have a husband and wife. The husband works in the private sector. The wife is a Colorado employee. She has this pension that she never paid FICA taxes on. If she tries to collect benefits as a spouse on her husband's record, Social Security is going to reduce any potential Social Security benefit by 2/3 of the amount of her pension. So let's say her pension is $3,000 a month. 2/3 of that is $2,000. Her benefit as a spouse is, say, $1,200 a month. It's going to wipe out her benefit as a spouse. The strategy I would say in this case is the husband probably wants to go ahead and claim his Social Security benefit at 66, if that's his full retirement age. Yes, he could wait till 70. Yes, he would get a bigger amount while he's alive. But the biggest benefit of delaying your benefit till 70 is assuming it's going to be passed down in the form of a larger survivor benefit. But his wife is unlikely to be able to collect much or anything of a survivor benefit because of her Colorado pension. So therefore, it may not be worth it in this couple's case for the private sector worker to delay.
All right, we've got a few more coming in. So next question is, if your Social Security form shows you'll receive $3,200 in benefits at age 70, do you multiply that amount by 32%?
No, the estimated benefit statement you receive usually shows 3 ages, either 62 for your earliest benefit or what your current age is now, at your full retirement age, and at 70. That age 70 amount is including the 32% in delayed retirement credits. So if your full retirement age amount is, say, $2,000 at 66, the age 70 amount's going to say 32% higher, $2,640 a month. But frankly, it's really going to be bigger than that, because here's another little secret. For every year you're eligible to claim Social Security, which means starting at 62, up until the age you actually claim it, each year in between that Social Security applied a cost of living adjustment, you get that cost of living adjustment for each year up until the time you claim. So the amount you receive at age 70 is actually going to be larger than that 32% increase.
All right, next question. Somebody would like you to please go over the example again that you gave of claiming spousal benefits early, and you used yourself and your husband as an example.
Okay, here's the key to remember. The magic birthday is January 1st, 1954. If you were born on or before January 1st, 1954, you can do something fancy. If you're born after that date, you're out of luck. You can't. But in my husband and I's situation, my husband was born in 1952, meaning he's grandfathered under these old rules. He is eligible to claim spousal benefits only on my record, but he can only do that if I claimed my benefits. Now, frankly, I had planned to wait till 70, but when they changed this rule, I'd say, okay, I'm going to claim my benefits at 66. Let's say it's $2,800 a month. And by doing that, now my husband, filed a restricted claim for spousal benefits that says, don't pay him his benefits, let them keep growing till 70, but in the meantime, let him collect half of mine. I get $2,800 a month. He gets $1,400 a month for the next 2 years. And when he turns 70, then he'll get his maximum benefit. And let me tell you a little story of how this works. And I just wrote about this a couple weeks ago. I was so smug. I applied for my benefits online. I immediately got a confirmation everything was accepted. I got a letter within 2 weeks. This is the amount I'm going to get. And the following month, I got my first deposit in my bank account. What could be easier? So once we had that letter in hand saying I had my benefits, I said to Mike, my husband, okay, now we're going to apply for benefits. And when you apply for benefits online and you're born before 1954, the question on the application will recognize that you're married and will recognize you're born before 1954. And it will say, if you're entitled to your own benefit and that is a spouse, do you want to collect spousal benefits only? Check yes. And he did. And we sent in the application and he got a confirmation that it was approved or was being processed. And that was just early December. And we went through Christmas and we went through New Year's and we thought, well, you know, things slowed down during the holidays. And we went through the Capitol insurrection and we went through the inauguration and still nothing. 7 weeks later, nothing. And I thought, this is not good. I'm going to follow this up. And I thought, well, it's probably because he's a federal retiree and the rules a little more complicated for him. So we had our letter in hand and it said Mike's benefits were being processed in the Boston office, even though we live in Virginia. We find the number for the Boston office and call us. And the first person said, oh no, you've called the wrong regional office. Nope, my letter says it's the Boston office. I want to talk to somebody. All right. And they transferred me to the second person who said, oh, well, he's collecting on your record. You'll have to talk to the person who processed your application. Okay, please transfer me. Third employee. No, I'm sorry, I processed your application, but somebody else processed your husband's application. Fine, please transfer me. Got to the fourth person. Yes, I see I have his applications. I'm ready to fight for these benefits. And she said, oh, looks like I never finished the application. I'm sorry, can you confirm that you're married? Can you confirm when you're married? Okay, all done. 2 weeks later, he had his benefits. So sometimes patience is a virtue and sometimes perseverance pays off. Be prepared to fight for these benefits. And you have questions, you talk to people at your wonderful financial planning firm. They'll have me on speed dial and I'll help you get through it.
All right. Well, it is 5 o'clock. Mary Beth was kind enough. She will stay around for a few more minutes. We have 2 more questions. And again, if you're on the call and you want to ask one, please do so. The next question is, if I have a spouse whose public survivor benefit would be eliminated by the GPO, is there a reason for me to wait to full retirement age to claim other than the 8% a year?
Well, if you claim before your full retirement age, your benefits are going to be reduced. And if you're still working, you're going to be subject to earnings restrictions. So at that point, it comes down to what does the rest of your retirement income picture look like? How important is this guaranteed income for you? Because for so many Americans today, so few people have pensions. Social Security may be the only form of guaranteed income for the rest of your life that's cost of living adjusted. Even most annuities and public pensions don't have a cost of living adjustment. So look at the value of it. If you really want the money now, go ahead and take it. Otherwise, you might want to wait till your full retirement age, but probably is not worth delaying till 70.
All right, next question. To collect at age 70, do I apply in my birthday month or will I receive the same benefits if I apply 4 months prior to my birthday month? If my birthday is mid-month, is that when I apply?
You can apply 4 months before you want the benefits to begin. So let's say you want benefits to begin in July. You could apply in April. And you write in the remarks section that you want your benefits to begin in July, your 70th birthday month. Now, normally when you apply, for example, for benefits before your full retirement age, There's these reductions for each month if you're applying before then. But in the case of 70, you can actually apply in your birthday month of 70. And there's a great calculator on the Social Security website, ssa.gov/estimator, and you can put in your birth date and when you want to apply for benefits, and it will tell you how much your benefits will be.
Next question is, for some of these more complicated questions, and with Social Security field offices closed, should I schedule a call with Social Security or should I just call the 1-800 number?
There, if you go to the Social Security website, ssa.gov, and in the search box, put in field office locator, you will come up with a place where you put your zip code in there, and it will give you the phone number of your local office. And they tend to be more responsive than the 800 number. You can always call the 800 number, but I think you'll get, you'll find more answers to your questions and help with applications if you call your local field office.
All right, well, so those are all the questions. I wanted to plug 2 reminders for folks. One being is that Obermeyer Wood, we are always happy to assist in any of these issues. And in many cases, we can call the Social Security office with you and be on the line if that's something that you would like. So please reach out. And the other issue too is we did record this, and Mary Beth has been kind enough to let us publish it on our website. If you have friends and family that you think might benefit from watching this, it'll be up on our website probably tomorrow afternoon. And feel free to send people the link or contact us, and we'll make sure that we get you squared away. So Mary Beth, thank you so much for joining us. I can't tell you how great it was. And if there's nothing else, we will see everybody at our next month's event.
Well, thank you all for paying attention. I got to talk about my favorite subject for an hour. I really appreciate it. And I hope I perhaps get to meet you all in person someday. Bye-bye.
Thank you, Mary Beth. Thank you very much.
Bye.
Thank you. Good to see everyone.